that's not helpful in running a business. So, I like to be proactive with my clients on the front end, and that's really where you get the value add from your CPA.
My name is Matt Tanner, and this is Franchisees United. Going on, guys. Welcome to episode 6 of the Franchisees United podcast. I am your host, Matt Tanner. Today, we have the privilege of having Dustin Grizzle, a rock star CPA from MGO, onto the show. Welcome to the show, Dustin.
Appreciate it, man.
So, we have so much stuff that I want to go over today because, but before I even dive into that, let's talk a little bit about who you are, what you do day to day, and the firm that you work for.
Okay. So, Dustin Grizzle, CPA, been doing this for about 15 years now. South Florida born and raised. My specialty is in high net worth individuals, focus in real estate, franchisees, entrepreneurs. The firm that I'm working for, MGO CPA, they're based in California. They have a big presence in state and local government, cannabis, real estate, ultra high net worth individuals, and of course franchises.
Cool. So, one reason I wanted to bring you onto the episode today is it seems like accounting is something that's super, I don't want to say the word boring, right? But it's something that is just kind of thrown on the back burner to a lot of business owners and franchisees, and myself, my brother, my family, we've all been guilty of it in the past, right? So kind of want to talk a little bit about why accounting is so important to the average franchise owner, some of the things they should be doing day to day with, their QuickBooks automation, their planning, they're preparing, they're budgeting, all sorts of stuff. So let's talk a little bit about why it's so important to have a good accountant, and B, to have good procedures and systems in place for, the average franchisee.
Okay, so let's start off with a good accountant. Before we get into that, accounting is boring. It's really boring. Mm-hmm. And I make it a point to never talk about it at cocktail parties because I'll see people's eyes glaze over. Yep. So I get that, but it's a necessity, right? Mm-hmm. The reason that it's so important is because it gives you a financial picture of what your business is actually doing. And the reason that you want a good accountant is because good accountants are, forward thinking and really helping you run your business. Crappy accountants are the ones that are historians, right? They tell you what happened. That's not helpful in running a business. So, I like to be proactive with my clients on the front end, and that's really where you get the value add from your CPA, and it becomes less boring, right? If they're telling you how you can make more money, that's less boring. If they can tell you where you're saving expenses, saving taxes, that's really why a good accountant's important.
Yeah, and it's interesting you say that because I really like what you said about the historian part, because I've worked with a lot of accountants over the years. I mean, my family has been through probably half a dozen different accountants, and my brother and I are super excited to build our relationship with you, with our portfolios and everything we have going on. But what you said about the historian is really interesting, because right when you said that, I'm literally thinking about the different CPAs that we have worked with that have pretty much done that. Yeah. So talk to me a little bit more about that. Like, why are some CPAs kind of wired that way versus some are more proactive and helping clients with planning and different things?
So I don't know if it's changing of the times, but you find with older CPAs or people who've been in the industry a long time, mm-hmm. that they're doing business the way that they've always done business and haven't adapted and evolved. Maybe you used to be able to wait 12 months before projecting out the next year. Things are moving so quickly now that you need to be possibly making changes monthly, quarterly, semi-annually, depending on what line of business you're in. And so I think CPAs now have taken on the role more of an advisor, business advisor, as opposed to just, I like to say, puts numbers in boxes, mm-hmm. right? My son always asked what I did when he was growing up. I said, I put numbers in boxes, just to keep it simple. But that's what a lot of, old school CPAs do is you mm-hmm. take the information at the end of the year, you talk to your clients once, and then you drop the information on a form, and that there's really no value add there.
Right, for sure. So let's talk directly to the franchisees that maybe are about to do a franchise agreement. Maybe they're about to do their build out. Maybe they're about to acquire their first location, right? What are some of the things they should be doing for any of those? Let's start with they just did their franchise agreement and they're getting close to doing their first build out. What are some of the things that are super important right off the top to you that you think they need to do from an accounting standpoint?
So from an accounting standpoint and from a business planning standpoint, they need to make sure that they know what their projected costs are and get it into a software that makes sense to them, or at least makes sense to their CPA. Whether it's QuickBooks Online, sometimes it can be as good as an Excel spreadsheet as long as it's detailed. They just need to make sure that they have forecasted and budgeted properly and have it evaluated by somebody in the industry, because there may be things that people are not aware of. For example, CAM, common area maintenance is something that first-time franchisees or people getting into a building first time, they may not understand how high the CAM charge might be.
Right.
And so, you think you're getting a property for $30 a square foot when you're really, 42.
Right.
That materially impacts your bottom line.
For sure.
So it's really all about planning, and then taking it the next step further after you figure out what software you're going to use is setting it up properly. Most people think, oh, I'll figure it out in 6 months after the business is up and running. Take the 5 hours or the $1,000, whatever it's going to cost you to get an accountant and a CPA to get everything clean from day one. That way there's no cleanup, right? If it starts off the right way and you're doing things properly, there's no need to worry about it in the future.
So what are some of those things that you have to start with? Like balance sheet, like what are all the different things that...
So number one is chart of accounts.
Okay.
And separating your lines of businesses, right? So maybe as a franchise owner, you've got a couple other things going on. You want to make sure that you have a dedicated bank account and a dedicated credit card, maybe even a dedicated line of credit associated with that business, so that there's no, transfers back and forth and commingling of funds. That way, you have a clear picture of exactly what's happening in the franchise. So once you set up the bank accounts and the credit cards, right, then it's getting a clear chart of accounts, right? Many people who try to operate their own books get themselves in trouble because they create a new account every time something comes up, right? Every time there's a new expense, it's creating a new account, a new account, a new account. Start with a standard set of accounts, and if something comes up that you don't know what to do with, drop it in the Ask My Accountant line.
Okay.
Or other information.
And I've seen that in QuickBooks Online.
Exactly.
Okay.
Yeah.
And is that the record? Is that your suggested software that people would use?
Yeah, QuickBooks Online, unless you're in a super highly specified field, maybe really high inventory clients, they might want to consider something else. Like there's a couple others out there I could recommend.
Right.
But for almost every single run-of-the-mill business, QuickBooks Online is more than capable.
Okay. Yeah, I've when I used to do my own books, I would drop tons of stuff. I would swipe it on my iPad, and I would swipe it over to Ask My Accountant, and I used to love that feature. So that's interesting you brought that up.
It narrows down the hit list that CPAs have to go over with you, right?
Right.
And then you learn as a business owner, okay, hey, now that I know where that one went that one time, you can look it up, and sometimes it even automatically codes to that line item in the future.
Right. So do you think it's important for franchisees to do their own books or to outsource it? Because I know it gets expensive. And talk to me a little bit about that, especially like the individual operator versus someone that has 20 locations. How important do you think it is for that franchisee to be familiar with their books and their profitability?
Okay, so what I would say, I always tell my clients to figure out what their time is worth, right? So if their time is worth, $200 an hour, does it make sense to pay somebody $50 an hour to do your books when they're going to do it well? Right. So that's the first step. But let's say there's zero excess disposable cash and they've gotten a little bit extra time. I still recommend that they engage an accountant to look over what they're doing. Right. So maybe instead of it taking an outside CPA 5 hours to look at something, maybe the franchise owner does 5 hours and then the CPA does an hour. Especially in the beginning, I cannot emphasize enough how important it is to get somebody who knows what they're doing to get you on the right path, right? Some of these CPAs, once they get you up and running, you can kind of take the ball and run. But in the beginning, it'll be really helpful to have somebody that's knowledgeable.
For sure. And like the multi-unit operators, do you think there gets, in your opinion, is there a point in time where it makes sense to have somebody in-house to do the bookkeeping, and then as well as maybe even just an accountant in-house? Like at what scale do you think it's worth it for them to invest in somebody in-house, or do you think it's it's just more important, or it makes more sense to work with a professional and outsource it.
So to have a full-time in-house accountant, it's probably we're talking a pretty big scale. You
Yeah.
know, maybe over 5 or 7 locations,
Okay.
something like that, depending on the sales
The
volume.
volume and the profitability, of course.
Typically, what I would advise is, somebody who is QuickBooks knowledgeable that wears other hats, right? So if you've got somebody that's a talented business manager or ops person that has 5 extra hours a month, maybe that makes sense to have them also do the QuickBooks as long as they're qualified to do so. Right. Then it becomes a cost benefit analysis.
You can kind of like allocate their salary between different positions.
Exactly.
So
one thing that I will caution is, everybody thinks that they can do, the books, and they think they're going to do the books. What ends up happening is the equipment that broke takes priority over the books. The person that you need to hire takes priority over the books. So what ends up happening is you're 6 months down the road and you don't know why you've got, $200 in the account.
Yeah.
Because you haven't been evaluating it the entire time. I've got a horror story of a client that I work with, owns a hotel franchise, and every single year it's you have to do QuickBooks this year. You have to. Oh, it's top of my priority list. We get to the end of every year along the whole way, and they don't touch it all year.
Yeah, and I think you brought up a good point, because as business owners or franchisees, your intent is there. Like, he wants to do QuickBooks, I'm sure.
Yep.
But if you lose a key manager or employee, what's really the true priority to you? Is it doing your bookkeeping, or is it getting in the trenches, hiring a new person, making sure your business is good? And I can, I have empathy for that. I can understand as a business owner, you have the right intent to do what you should be doing, but then all of a sudden things happen, right?
Yeah.
And you have to manage your business, and you have to, do the right things to get your business back up and running properly. So I do understand that. So I guess let's kind of, pivot into when we're setting up, going back to, starting a franchise location.
Yeah.
Talk to me about the franchise fee. So like the upfront expense that you pay the franchisor to have the rights to use their brand, as well as your royalty cost when you're managing your business and throughout the franchise agreement. So talk to me about what you can do from an accounting perspective with that franchise fee, as far as writing it off and all of that stuff.
Yeah. So the franchise fee, obviously it depends on the agreement. So you need to figure out what the agreement says. Is it a one-time upfront cost? Some of them are annual plus a percentage of sales. There's varying levels, and we try to take the most aggressive position we can within the law to get the taxpayers as much of a write-off in that initial year as we possibly can. It's important for cash flow purposes that they do determine what their all-in franchise cost is going to be over the course of the first 12 to 18 months, because if you got the big hit out front and then 6 months later you've got another, or quarterly you've got another, that's going to severely impact cash flow needs, especially while you're doing build out and you're doing hiring, and the revenues aren't coming in yet. People don't the biggest mistake that people make when they're starting a business, especially a franchise, because of the front-loaded cost, is they don't project how slowly the sales follow the investment, right? So it may be a 3-6 month window of where you're running cash flow negative during that process.
And another thing I've seen to kind of play off of that here is the restaurant franchise owners. Usually they have that honeymoon period where they're slammed in the beginning, but then they hit that cash flow problem after a couple months. And I've seen that with so many operators and so many restaurant and franchise owners. So how do you prepare for that? Because that's kind of the reverse, where you have all this cash coming in the first 30 days and you're ecstatic, right? You're making money, you're hiring more people, you're investing more into your marketing, and then all of a sudden maybe a slow season comes up. How do you prepare for that?
So I typically advise all my clients to get a very good banking relationship. And so not only should the franchise owners be economically planning for that downturn, because it is pretty, it's a pretty cyclical, thing that you can predict. but they should also have a working line of credit with a bank. They should have a good relationship with a bank where they can draw down on some debt during the periods where things do slow down, right? Because the last thing you want to do is take your foot off the gas pedal, right? If you've got people interested in your restaurant, you don't want to say, okay, hey, we're gonna keep all our money because we're gonna hit a slow period, right? You still want to be smart about pumping money into hiring and
the marketing.
Marketing.
Yeah, for sure.
Yeah, but good working line of credit is probably one of the best ways to plan for that.
Yeah, and I've seen a lot of franchisees that go acquisition mode. They go SBA financing.
Yeah.
So talk to me a little bit about that, because I personally love SBA financing. I mean, anytime you get the chance to amortize it over 10 plus years, and then you have good cash on cash returns and good monthly cash flow, I think it's a great opportunity to get some leverage and buy really well or high performing businesses.
Yep.
So what have you seen with the SBA model?
So I'll tackle two different sides with that. So on the SBA model, it's excellent, just like all the high points that you mentioned.
Yep.
They're also I'll say simpler to qualify for than like a traditional financing from a bank would be.
And is that because the government backs it?
Yeah.
Okay.
So you don't typically need audited financials in order to get SBA loans unless they're above a certain threshold. But more specifically on the opposite side, I would encourage people who go into acquisition mode to spend the money on due diligence on the acquiring companies, right? The companies that they're going after.
Yeah.
I think sometimes people rely too heavily on, they're in a great location and they've had great sales.
Yeah,
right?
They get blinded by the light.
Exactly.
Yep.
So I would encourage them to take the foot off the gas pedal, maybe engage a third party like a CPA, an attorney, a business advisor, to have them just take a second set of eyes on a set of books to highlight where maybe some problems are, whether it's economic slowdown in the area, maybe it's disinterest in that particular brand in that area. Maybe a new competitor jumped up across the street.
Yep.
I always try to tell myself, well, why are they selling, right? And think about what's going on in that industry. Maybe it's a perfect scenario and you're buying at the right time and they're just looking to get out, right?
Right.
But there could be underlying issues just underneath the hood that you need to take a look at.
Yeah, and there's going back to what you said about why are they selling. That's always something my brother and I always think about so much, because we're just, when we look at a business that's making hundreds of thousands a year and they have a GM running it and they're involved in other things, we always think, why would they sell that? Because buyers are winning. Buyers that overpay for businesses are still winning in the long run, more times than not, from what we've seen. And it just doesn't make sense at times why business owners are selling their businesses. You have to really do your due diligence and understand why they're selling their business, especially with individual franchise operators. Because what we've seen, a lot of franchisees, they're just, and sometimes it's very genuine. They're just very tired of their business, and a lot of times, I've kind of, back in my days in Tuscaloosa, I made a living off buying businesses from owners that were just tired of it. Yeah. And then also, one of my locations was an absentee owner, and you can just see, because it's important to be able to look at a business and see what's wrong with it, as far as what's actually going on. But then also having someone like a CPA or someone that can do the due diligence with the bookkeeping and all that stuff. And in the franchise industry, the nice thing is you can get like those certified sales reports, and you can see the POS systems. You're able to see exactly what their sales are. And one thing that we've seen a lot of is through acquisition is we don't even really care about a franchisee's P&Ls, as crazy as that sounds. Yeah. We say, okay, what's the rent? What's their top line? Like, what's their revenues? And then we have our own pro formas that we use. Yeah. And especially if you're kind of accustomed to a certain brand or industry, you just know what truly matters is what you as the buyer can do with that business once you own it. And of course it matters what they were making and all that stuff, but what's important to us when we look at businesses is we want to know what their rent, what their lease looks like, and then what kind of sales they're doing. And then we can kind of see from the outside looking in, okay, we can run the business better or worse, or can we keep it the same, and does it make sense to buy the business? But kind of touching on what you said, I just think it's crazy. I think it's crazy to not do real due diligence when you're looking at a business, and I see it all the time of people that are kind of they have just so much confidence in their abilities to grow the business
Yep.
based on what they're seeing, but they're not really doing proper due diligence. So do you help a lot of franchise or business clients do the due diligence, and what's your process like when you do that?
Yeah. So actually, it's a very similar approach to what you talk about.
Mm-hmm.
Is we determine what the top sales numbers are. We like to look for trends.
Right.
So we look for several years, right? If you're seeing the trend line going down significantly each year,
Mm-hmm.
that would be an indication to us that maybe something's going on there.
Yep.
But then we look at their fixed overhead, right? Those costs that you can't get away from.
Right.
The rent, the profit margin per product or whatever you're selling.
Right.
And then what we do is we back out. How you say you bring a pro forma in.
Yeah.
What we do is we take their P&L and we back out the expenses. Maybe the owner's taking too high of a compensation.
Yep.
Or
or they're writing their insurance off.
Yeah.
Or their
They've
son's
got 4 cars.
Yeah.
Their son, their wife, and their dog work there. It's we do the opposite of what you do, and
Yep.
so where that would be beneficial is if I always ask the business owner, what do you think is going on here? Not only in their own business, I always
Right.
ask that question. How do you think this year went?
Mm-hmm.
And then I tell them what the numbers say the year went, and then we find a way to meet in the middle of like, okay, here's why either your perception is wrong, or
Mm-hmm.
here's why my perception is wrong. And we kind of figure out what the numbers are saying versus how the owner operator feels. And we do the same on acquisition, is backing out those expenses that really don't make sense, and then determining fixed overhead is really the way to do it.
And you almost need someone with a conservative or like a pessimistic view on it, because I'm telling you, as like an entrepreneur, like a business owner, you just want to do deals left and right, and
Yep.
you just think that you can buy any business and you can turn it around and you can be the hero, and it's just not always the case. And especially looking at the leases, I mean, it's huge. So many business owners don't really look at their lease and understand it enough, and having someone that can really dive into that, like, is there a personal guarantee? And that's a whole nother conversation for another episode that we could, dive into left and right, and so many different things to talk about. But what else do you want to kind of go over here with franchisees? What are you seeing? What do you think that they need to know about, really?
So really the biggest one that I always want to advise clients of is, let's say you've been a operator or a GM of a franchise, right? And you
Mm-hmm.
think that you can go out and do this on your own, right?
Mm-hmm.
You're now transitioning from a W-2 employee to a business owner.
Yep.
Okay. That comes with roles and responsibilities from the federal and tax side of things that you're probably not prepared for.
Yeah.
And so it's really setting yourself up with a good set of professionals. The 3 that I always recommend are bankers,
Mm-hmm.
attorney, and CPA. Get yourself 3 trusted people that know the industry that you're getting into,
Mm-hmm.
and have them be essentially your board of directors, right? You're going out and you're buying one franchise.
Yeah.
So have a board of directors,
Yeah.
right? Even if it costs you a little bit of money on the front end, you will not regret it on the back end. So the best example is for taxes. You have to register for unemployment tax. You have to register for sales tax. You have to register, in the state that you're doing it, and then you have filing requirements that you have to meet. Some of them are monthly, some of them are quarterly, and some of them are annually. Right?
Mm-hmm.
These are things that you need an advisor. You need a CPA that's doing it regularly to help you out with. And then, more importantly, is quarterly taxes. When you're a W-2 employee, and now you're making the transition to owner, nobody's withholding on your taxes now. These income items that you're earning through the franchise flow through to your personal tax return,
Mm-hmm.
which means that you are now responsible for the tax. I can't tell you how many people think that they've got, $100,000 in their personal account in reserves, just extra money that they're holding on to. And it's
Mm-hmm.
like, well, you owe 50 of that to the IRS, plus penalties and interest because you haven't been making payments all along.
Right.
And those first couple of years on the tax side are typically a surprise to people who are making the transition from employee to franchise owner.
Right, right. So one last topic I wanted to go over that we didn't even touch on yet. How do you recommend franchisees should compensate their key employees? So whether it's a GM or maybe it's a district manager, how should they go about compensating those individuals?
So depending on the industry, you can get pretty creative. But what we see frequently is some kind of base salary with a some form of compensation related to the performance.
Right.
Whether you want to tie it into a net revenue number, gross revenue, net profit. There are a couple different ways to slice that, and it would depend on the industry.
Right.
But for key employees, you want to structure their compensation so that they have more incentive for the business doing well. So along with doing performance-based stuff, we'll also recommend doing some kind of profit-sharing plan on the retirement side, right? So if you care about these employees, and especially the key employees, you want to make sure that they're funding their retirement as well.
Yeah.
And so you can do that by instituting a profit sharing plan, which gets them some tax deferred income, right? And that's a win because they're saving 20 to 30% in taxes in that extra compensation.
So when the business owner, like what you're just saying about them putting money into a retirement plan for the key employee, would they just directly put the money in, or would they pay the employee and they would then contribute it to it?
It's a check cut directly from the franchise owner into a special account for the benefit of the key employee.
Okay, and then how do they go about? How does the franchisee or the business owner go about writing that off? Then it's just wages.
Yeah, it's a deduction. It's actually it's a benefits deduction, so you get it as like a retirement plan deduction. And we help our clients structure retirement plan benefits, and not to sound greedy, but we heavily favor the owners, right? So that the owners get to contribute the most money to their own pocket. So they take it from their right pocket, they put it into their left pocket, and they get a deduction for it.
Right.
So it's a no-brainer for most owners. And then they, in order to be able to do that, they have to fund some of their other employees' retirements as well. But it's disproportionately large to themselves. So most clients that have some extra cash flow really enjoy that tax savings opportunity.
Yeah. So what are some of the other key deductions that franchisees should be taking, or that you see that they're not taking sometimes, but they should be?
Yeah. So it's really, it's being thoughtful about your business and the timing of deductions. So, I tell clients to never spend $1 to save 30 cents, right? You don't want to spend money that you don't have to just to get a 30% deduction.
Well, so many people use it as an excuse. They're like, oh, I can lease a car because it's a write-off.
Yes.
So, tell me a little bit about that.
So what I like to tell them is, pick things that you actually have to do and have to spend money on. So, perfect example, let's say a fryer in the restaurant industry is it's going any day now, and we're in December.
Right.
I would tell them to buy it in December. Buy the new fryer in December. Get rid of the old one in January, and that way we've created a deduction in that current year and gotten the full write-off, accelerating it a full 12 months. Just by purchasing it in December as opposed to January.
Right.
So it's planning like that. Sometimes tax incentives come along, like if you buy a large SUV. So let's say you were planning on buying an Explorer, but you could go up to a Yukon, and the price difference is $5,000, but now you get to write off $65,000 in the first year because you made the decision along with your accountant to buy just a little bit bigger car. Now, that doesn't work for everybody, but those are the types of things that you walk through when you're trying to figure out how can we get some extra benefit, right? Get some extra deductions.
Right.
And one additional comment on the profit sharing plan, clients love this, is you don't have to actually fund some of these contributions until 9 months into the next year. So you can actually see. So let's say for 2019, you can create a deduction for 2019 in September of 2020, just by seeing how your year went, and you have to fund it by the time you file your extended tax return. So if your extended tax return isn't due until September, you don't have to pay the deduction until...
So you can get the write-off without actually paying it out.
Correct. Yep.
Okay. So how could that work for an employee? Because, I know, like if a franchisee just had a phenomenal year, and say they have a couple key employees that they know are with them for the long run, how can they go about giving them maybe a huge bonus, or even maybe an advance in pay in maybe November or December for that calendar year for the future? What's the best way for them to do that?
So what I what I've seen is people giving. So let's say you did a great job, and I wanted to give you $100,000 bonus for something.
Yeah.
What I would do is I would structure it where you get 50 now,
Mm-hmm.
you get 25 in 3 months, and you get 25 in another 3 months, right? Where I'm staggering it out to keep you still incentivized, but I've told you, hey, your bonus is $100,000.
So you just do like an agreement?
Yeah.
And then you can use that agreement as like you write off the full $100K, even though you've only paid out 50 yet?
It depends.
Okay.
So with depending how important they are and if they own any share of the company, that determines when you have to pay it out by.
Okay.
So like sometimes, let's say they own none of the company. What you could do is you could give them 50 now and then 50 in, I think it's like February. It has to be paid out before like March 15th, I think is the deadline.
Okay.
If you want to get the full deduction in 2019.
Yeah, that's very interesting.
Yeah.
I never knew it. I honestly didn't know that.
Yeah.
That's very interesting.
Yeah, it's accrued compensation.
Cool.
Yeah.
So did I ask you what your advice was for a franchisee? Did you already do that one?
Yes.
Okay, so next question. Who is somebody that should be on the show for the future as we wrap up here?
That's a great question. I've been thinking about it a little bit. I don't know if you guys are friends of Chick-fil-A, but I know an owner-operator that's got 2 stores.
Okay.
And he's on boards of they've got, boards that they run out of Atlanta. So he's a pretty heavy hitter in the, one of the top grossing.
Is he local
Chick-fil-A.
or no?
Yeah, he's local.
I'd love to meet him.
Yeah. So Paul Kiedis, excellent dude. And he's getting the West Boca store. And if you know Chick-fil-A's model, they don't give 2 stores.
Yeah, very rare.
You have to be present at both of them all the time.
Yeah,
but he's done so well with. He does all of the FAU games. He does just massive catering numbers. He's got the Chick-fil-A truck, the food truck.
Wow.
And then the mall. So.
Yeah. Chick-fil-A is an incredible brand. It's not something I would ever get into just because of the fact that you can't do multiple locations and really build and do other things.
And you have to work there 40 plus hours a week. They make sure that the owner operators are actually there.
Their model is very, very impressive. So I would love to have a Chick-fil-A franchisee on the show. So I'll definitely reach out to him, try to get him on here. So that's pretty much it. Any last words or anything you want to touch on?
No, I think this has been great. I appreciate you guys bringing me in.
Yeah, thank you so much. So thanks, guys, for listening to episode 6 of the podcast. Make sure to subscribe on YouTube, Instagram, LinkedIn, or Facebook. We're at Franchisees United.